Hello again and welcome back to our course on Excel 2019 Advanced. In this section, we're going to start to look at financial functions, and there are a very large number of financial functions in Excel, and some of them are used for personal finance, some for professional finance used in commerce and industry, and some can be used in either. There are some aspects of using financial functions that can take a little bit of getting used to, and in this section I'm going to demonstrate and explain one of the most commonly used financial functions, and in doing that I will explain some of the terminology and other issues that you need to be aware of when you're working with these types of functions. Now, the first function I'm going to work through today is PMT, or the payment function. And basically, we generally use the PMT function to work out the payments on a loan. Now, it's a little more powerful than that, and there are quite a few options that are associated with the payment function. And again, I'm going to use this section as an opportunity to explain these. One of the first things that takes some getting used to is some of the terminology. So what I have set up here on this first sheet to begin with is a set of 5 things in cells B2 to B6. We have rate, NPER, PV, FV, and type. And I'm going to explain what all of those are, and then subject to what I'm going to explain, we're going to be able to calculate a payment. Now, one other term you might see from time to time when you're working with financial functions is the term amortization, and many people don't know what this actually means. Amortization, in a general sense, is spreading something out, in this case payments on a loan, or it's effectively the schedule of repayment for a loan. It can also be used elsewhere in finance for things like how you spread out over a period of time the depreciation on an asset, but don't let the term amortization confuse you. It just means a schedule of payments, or in this case, a loan, and how you spread those out over time. Now, what I'm going to do first is click in cell C8 here, and I'm going to introduce you to the payment function. So it's PMT. And you can see that there are actually 5 arguments, and those arguments correspond to the terms I've listed in cells B2 to B6. And in order to explain each of these, let's bring up the useful functions dialog box. Now, the first term is rate, and this is the interest rate period for the loan. And one important thing to bear in mind with Excel and the payment function is that it doesn't always have to work in years or any other specific units. So if you're trying to work out monthly payments, you need to put in here the monthly interest rate. And look at the example there. Use 6% divided by 4 for quarterly payments at 6% APR. So that's how you can enter an interest rate for the period other than an annual period. Next, we have NPER. This is the total number of payments for the loan. So on a 5-year loan on monthly payments, that would be 60. PV is the present value. Now, in this case, the explanation there is probably a little confusing. If you're thinking of a loan, in the case of a loan, that would be the principal amount of the capital amount of the loan. So if we were borrowing $5,000, we would put $5,000 in there. And if the intention is to pay off a loan completely, the future value, the value you want to be left with, is 0. Now, it may be that what you really want to do is reduce the amount that you owe somebody, so you're not going to go down to 0 in this case. You'd put a non-zero value in here, but we will go into that in more detail later. And then the 5th item, type. This is a logical value. It's 1 or a 0. If it's a 1, you're going to make the payments at the beginning of the period, and if it's 0, you're going to make the payments at the end of the period. The significance there, of course, is that if you make a payment at the beginning of the period, you're not going to incur interest on the amount of that payment through the period. Whereas if you wait to the end of that period, you'll be accruing interest on the amount you haven't paid until the end of the period. So let's work through an example of this. Let's suppose we want to borrow $5,000. and I'm going to pay that loan off, so the future value will be 0. And I'm going to make the payments at the start of each period. The payments are going to be monthly payments over the course of 5 years, so there will be 60 payments, and with a 5% annual interest rate. Let's now work out what the payments are. So the rate is C2 divided by 12. This will give me a monthly rate. The number of periods is C3 and the present value is C4. The future value, C5, and the type is C6. Let's see what that comes up with. So I have currently a monthly payment of $93.96. Note that the payment's showing in red, and that means it's a negative amount, and all that basically indicates is that the money is going out. So that's a very straightforward example of the use of the PMT function. Now let's take a look at one or two changes to some of these arguments. What do you think would happen if I changed the type from 1 to 0? So instead of making payments at the start of the month, I make them at the end of the month. Would that increase or decrease the payment? Well, based on the fact that there would be interest to pay on the monthly payment amount, which I would be hanging on to for the month, if I change this to 0, $93.96 will go up, and in fact it's become $94.36. So that's about 40 cents a month extra if I make the payments at the end of the month. Now what about looking at that figure $94.36 and thinking, well, I can't really afford that much each month. What about trying it over 10 years? So let's try 120 months. Well, that reduces the payments to just over $50. So with this arrangement, it's very easy to adjust each of those arguments and see the consequences in terms of how much you'd need to pay for this loan. Now, one other thing I would like to show you, which is something that tends to confuse people quite a bit. What if my intention was not to pay off this loan, but to finish up with a reduced loan? So I want to reduce it from $5,000 to $1,000. I'm currently planning to pay $53 a month to completely pay off the loan, but what if I didn't want to completely pay it off, but just reduce the loan to $1,000? Now what I'm going to do here is for future value, I'm going to change it from 0 to 1,000 in the mistaken belief that it means I still owe $1,000. It's not $1,000 though, it must be minus $1,000. The value to me is minus 1,000 because I still owe $1,000. And you'll see that now my monthly payments have gone down to $46.59 a month. So having looked at the payment function, we're going to move on in subsequent sections to look at other financial functions. That's the end of the section, folks. I will see you in the next.